Welcome to this presentation on economic and market trends. A new phrase that is being used very frequently in economic and market analysis is the new normal. The new normal means different things. It is used to denote to the very low growth rate that we have globally, and also the very low growth rate in many countries of the world. In the market perspective, the new normal phrase is used to denote the high level of volatility in stock markets and currency markets. Even the bond markets are extremely volatile. Markets are always volatile, but the extent of volatility recently has been excessive. It is not normal for the developed markets to shoot up by 3 to 4% in one day and come down by 3 to 4% the next day. But it has been happening. European markets, Japanese markets, even American markets have been exhibiting excessive volatility. Investors are finding it difficult to comprehend this high level of volatility in the markets. Therefore, let us try to get the issue in perspective, try to understand the reasons for this volatility, and then formulate our investment strategy based on that. Presently, there are broadly two views regarding the global economy and markets. One is a very bearish view, and the other is a neutral to long-term bullish view. Let me explain that. The bearish view is that the global economy might fall into a recession this year. Many fund managers and economists have been pointing to the possibility of another global recession in 2016. The logic of the people who make this argument is the Chinese economic slowdown is very sharp. China has been growing at more than 10% for a long period of time. Now it has slowed down to around 6%. The official figures are 6.5, but there are people who believe that it is around 5 to 5.5, going by high-speed data like the freight rates, electricity generation, etc. China has been the fastest growing economy in the world for many years now. And in the last 10 years, 33% of global growth came from China. China contributed 1/3 to global growth. Also, 50% of the incremental demand for commodities came from China. So when such an economy slows down, naturally it will impact the global economy, particularly when other economies are not growing very strongly. And we have seen the commodity crash, not just the crude crash, the prices of most commodities have come down drastically. So commodity exporters like the Middle East countries, Brazil, Russia, South Africa, etc., are finding the going tough. Countries like Brazil and Russia is in very serious recession. So since commodity exporters are in deep trouble and China is slowing down sharply, that might push the global economy into another recession. Markets have not fully discounted this. This is the bearish view, and that is why whenever data indicating this view, relating to this view or confirming this view appears, the market takes a beating, the bears pound an onslaught, and then the market goes down. The other view is a neutral to long-term bullish view. This view does not subscribe to the global recession theory. I believe in that camp. I am in that camp. I believe that the global recession is a possibility. I would put only a 10 to 15% possibility to that. The reason is simple. US economy is coming back to reasonably good growth, much better than everyone expected. The employment figures from US are very reassuring. The latest data, which came on the 4th of March, indicate 2,40,000 new jobs being created in the last month. Wages are slowly going up. The unemployment rate is around 4.9%. This is near full employment levels. Housing industry is in good shape. And the crude price crash has substantially benefited American consumers, and therefore consumption has picked up. America is even now a net importer of crude. So when the world's largest economy, the American economy, the 17.6 trillion giant, is growing at a healthy pace, there is no possibility of a global recession. Also, people who subscribe to this school of thought, who believe in this trend, believe that the commodity price crash is only temporary. The crude crash has more than the demand-supply dynamics to that. There are geopolitical issues, there is the Saudi-Iran conflict, the proxy war that they are raging in the Middle East. There are so many issues. Already we have seen that the Brent crude has appreciated almost 50%. As I speak, Brent crude is more than $39. So it is appreciated by around 50% from the low that we saw in recent times. And also the latest data indicate that iron ore prices, zinc prices, aluminum prices, and most of the metal prices are slowly indicating an uptrend. Many of the factories in China producing these metals are getting closed. So there is a light at the end of the tunnel as well as the shattered commodity industry is concerned. So because of these reasons, another global recession is likely. Soon we will see a return of business confidence and optimism. Global economy can easily grow by more than 3% this year. The IMF target is 3.4, but even 3% will be okay. Global recession is when global GDP growth goes to less than 2%. That possibility is remote. So whenever news relating to this particular trend which I have explained, the neutral to long-term bullish view appears, when data confirming this view appears, the market very quickly rebounds. That is why the markets are excessively volatile, and we have this new normal situation of hyper volatility in the markets. Coming to India, in February, India has been one of the worst performing emerging market. There was one particular reason for that. There were rumors going around that the long-term capital gains tax will be tweaked, and the time period will be reduced to will be extended to 3 years from 1 year. So that led to a lot of bear hammering, and there were some reservations regarding the budget. There were not much of expectations from the budget, but the budget proved to be a very good budget under the circumstances, and also the much feared long-term capital gains tweaking did not happen. The budget did not do anything bad to the markets. It did no harm to the markets, particularly containing the fiscal deficit at 3.9% of the GDP for this year and projecting 3.5% fiscal deficit target for 2016-17 came as a shot in the arm for the markets. Immediately, the 10-year bond yield appreciated by almost 20 basis points in a single day. This is a reflection of the confidence of the markets in the ability of the government to contain the fiscal deficit. Also, the macroeconomic parameters of India are very good. Economists normally use four indicators to judge the performance of an economy. These four economic indicators are the GDP growth rate, the fiscal deficit, the current account deficit, and inflation. Judging by these four macroeconomic indicators, the Indian economy is doing exceedingly well. Our GDP growth rate this year is 2015-16 is 7.6%, 1% more than what it was 2 years ago. Our fiscal deficit is now 3.9%. It was 4.2% 2 years ago, and the present government has targeted 3.5% fiscal deficit for financial year 2017. Current account deficit touched 4% of the GDP in 2013 at the height of the taper tantrums. But now the current account deficit is completely under control thanks to the crude crash. The current account deficit is only between 1 to 1.5%. It is not likely to deteriorate. And CPI inflation, which was 9.5% 2 years ago, is now down to around 5.6%. The monetary authorities have succeeded in containing inflation. The last 1 year average for CPI inflation, according to the economic survey, is 4.9%. That's why the RBI could cut interest rate 4 times last year, and more rate cuts are in the offing. So if you judge the performance of the economy from these 4 important macroeconomic parameters, the economy is doing well. Of course, there are some reservations regarding the GDP growth rate. Is 7.6% real, etc. Now, there is a consensus that there is nothing wrong with the data, but very importantly, what we have to understand is there has been a big slowdown in nominal growth rate. Our nominal growth rate, GDP growth rate, for the last 10 years, 15 years, has been around 15%. 8% growth rate plus 7% inflation gives you 15% nominal growth rate. Or 7.5% GDP growth plus 7.5% inflation gives you 15% nominal growth rate. But now, thanks to decline in GDP deflator, the yardstick or the indicator which is used to convert GDP at current prices to GDP at constant prices, that is called GDP deflator, that is very low, less than 1%. And consequently, our nominal GDP growth is now around 8.1%. So remember this is very important. GDP growth rate, which was well above 10%, 12%, even 15%, is now down to 8.1%. Corporate top lines, corporate bottom lines, the salaries which people receive, all these are expressed in nominal terms, not in money, not in real terms. So in real terms, the economy is growing at a respectable rate, but in nominal terms, there is a very big dip, and that is why corporate earnings are not showing any uptick. That is a problem, but we are at the trough of corporate earnings growth and the trough of the GDP growth rate also. Of course, it has taken the growth rate recovery and the corporate earnings recovery have taken much longer than most of us expected, but it is important to understand that corporate economic growth recovery and corporate earnings recovery is imminent. It may take maybe two more quarters. We have some issues like the rural distress and the high NPAs of the banking system. The government is addressing both these issues. Hopefully, we will have a good monsoon this year, because during the last 150 years, India never had 3 consecutive monsoon failures. So going by the law of averages, we are likely to receive a good monsoon this year. And this will go a long way in substantially boosting the rural sector, the agricultural sector, and the economy in general. Therefore, we subscribe to the neutral to long-term bullish view of the economy as well as the markets. Therefore, what should be the investment strategy which investors should follow? Already we have seen after the presentation of this very good budget, 4 days consecutively the market has been going up. The Nifty is up 6.5% in 4 days. The Sensex is up by 6.4%. Mid-cap indices, small-cap indices, bank indices, all these are sharply up. We believe that this volatility will continue. There can be again ups and downs, but we believe that the worst is behind us. And a very positive factor from the market's perspective is the return of the FIIs. In the last 4 days, FIIs have been buying consecutively. In January and February, they were very consistent sellers, big amount sellers. But now they have again turned buyers, not a small amount, but respectable amounts. And if the mutual fund inflows, domestic mutual fund inflows continue, it should, because the market has turned, the market is poised for much better times. Of course, I repeat this point, volatility will continue, different sets of data will emerge, different data confirming the two views, or rather indicating the two views which I have explained, will again emerge, and the markets will be responding very strongly towards that. But then long-term investors should not be bothered about this. We believe that this is the time for making the systematic investment, SIPs in mutual funds, SIPs in equity funds, SIPs in balanced funds, and also in good quality stocks. Many blue chips are available at attractive valuations. Stock prices have corrected substantially. So this is an opportunity to buy good quality stocks, both large caps as well as mid caps. This is a time to buy systematically. This is a time to buy systematically with a lot of patience. Investors should always keep in mind a very important factor, and that is India has the best growth potential among all emerging markets. In fact, there is a global consensus on that. Therefore, the growth recovery and earnings recovery will certainly happen. It might happen 2 quarters or 3 quarters later than we expect, but certainly it will happen. The India growth story is inevitable, and therefore, when the growth rebounds and the corporate earnings rebound, the bull market will resume and investors will benefit substantially if they show patience and invest systematically during the present turbulent times. Thank you.